Hi guys, Tony Gattari here from Achievers Group with another passionate, practical business insight. Hey guys, really what I wanted to share today is basically just 10 ways to evaluate a market. And these are really 10 very sound strategies to determine whether you should be in business and what sort of business you should be in. The first way to evaluate a marketplace is the urgency. The key question is, how badly do people want and need this right now? It's a good question. Because, I think there's an old saying, I think I heard it. I once did a seminar and I asked people, if you were building a restaurant, I said, what do you think you've got to have? And a lot of people yelled, well, I think you've got to have good food, and I think you've got to have good service. I think you've got to have a good location. I think you've got to have a good menu. I think you've got to have great value for money. I think it's got to be clean. And I think you've got to do good marketing. And I think they're all very, very sound ideas. But fundamentally, if you want to build a restaurant, the key is making sure that you actually have a hungry crowd. Number 2, market size. How many people are actively purchasing things like this? So you've effectively got to determine what is the market for the products or the services that I'm about to sell. Is the market 1 or is it 1 million? Number 2, pricing potential. How much are the people willing to pay? Now, this has got very little to do with the cost price. This is value-based pricing, not cost-based pricing. Cost-based pricing is when you buy a product and you put a markup on it. Value-based pricing is based on the assumption how much is the market willing to pay for this product and service. Number 4, what is the cost of customer acquisition? It's really quite simple here. How easy is it to actually acquire a customer? Because really, in building a business, you really want to reduce the cost of acquisition and increase the life of every customer. And you've got to ask yourself the question is, how much money do I need to spend in order to acquire a customer? The next idea is, what is the cost of the value delivery? Which means, how much would it cost to create and deliver the value offered, both in money and effort? Is it going to cost you a lot of money? Is it going to cost you a little bit of money? Are you building a spaceship that's going to cost you an absolute fortune? Can you ever get a return on that investment? So there's some of the key strategies that you've actually got to sort of come to grips with. Next one is, what is your uniqueness of offer? Are you unique or are you just me too? Now, it's very dangerous to be me too. It's very dangerous in the global economy where the internet breaks down barriers, because if you are me too, you are open to the savage competition of commoditization, where people are searching around the world for the best possible prices. And we consistently now see this in retail, especially retailing of commodities, things like computers, things like books, things like fashion brands, things like electronics, where people are not content just buying it from traditional retailers, but are actually doing research on the World Wide Web and actually buying products overseas and shipping them in. Next one, speed to market. How quickly can you create something to sell? Is it going to take you a year? Is it going to take you 2 years? And these are some of the key ideas that you've really got to come to grips with if you're about to start a business. Next one is, what is the upfront investment? How much do I need to invest in order to start my business? Is it a huge investment? Is it a small investment? Clearly, if I'm going into business right now and I'm relatively new to business, I would start a business now with a very, very small upfront investment. Because I'm figuring that you may actually stuff the first business up. And what you want to do is you want to minimize your losses. But clearly understand what is the cost of actually getting into business. Is it a physical business where you've got to buy stock? Or is it a virtual business that can actually be built on the internet in relatively quick periods of time? What is the upsell potential? What other products and services can you present to purchasing customers? What I mean by that is that once you've actually got a customer, the question is, what else can we sell to them? Because really what you're actually trying to do is you're actually trying to resell consistently to your existing customers. We call it milking your own cows. And I think it's really, really important to actually milk your own cows. Next one is the leverage potential. Basically, which means that once the initial offer is created, how much additional work will actually be needed to continue to sell it. For example, consultancy practices usually have a lot of effort to maintain it because somebody still has to consult. So that's why they sometimes call practices not businesses, because effectively the leverage is limited because it's very much based on the people actually doing it. You can't sell it again and again and again and again and again and again. But other more traditional products, you make it once and you can continue to sell it ongoingly. So there are just a couple of ideas of just 10 ways to evaluate a market, to really evaluate whether I should be going into business, but more importantly, what sort of business you should be really going into. Because clearly that is a very clear guideline on the questions you need to ask yourself in building your business plan. So guys, I just wanted to say thank you once again for joining us. Until next time, God bless you. Bye.